Well, good morning. Welcome back to the broadcast, Retirement Network. I'm Jeff Snyder. This is BRN AM for Thursday, October 14th, 2021. And our top story today, transparency and ESG should go together. Well, joining me now to discuss this and a lot more is Margaret Dorn. She's head of ESG indices for S&P Dow Jones Indices. Maggie, great to see you. Thanks so much for joining us on the program this morning.
Thank you, Jeffrey. It's an absolute pleasure being here. Thanks for having me.
Yeah, and I really am looking forward to connecting and talking about indices and also kind of broadening it to ESG. Let's start off with a conversation about transparency. ESG, a big topic around the globe, not just here in the States, but something that people all around the world are looking at. But there seem to be some challenges with transparency, and I want to get your thoughts on that.
So it's a fantastic question, and I think it's also a great place to start. So first and foremost, I think for investors to be able to really cut through the noise and kind of remove some of the dark clouds that are hovering around or over ESG investing right now, I think transparency, to your point, really has to be the center of the conversations. And I think the lack of transparency around ESG or more broadly, let's just say ESG funds or strategies really stems from two key issues. So hopefully we can address both of those. So number one, the lack of transparency around ESG scores or ESG data sets that are being used as inputs into these ESG funds or strategies is a really key part of the conversation. And the second point is the lack of transparency or clarity around ESG sustainability objectives within these funds. So maybe I'll pivot back to the first point and then hit upon the second, and I'm sure we'll probably have some other things to discuss after that. So if we take a closer look at the transparency from a data perspective, it's all about the question of what is a number, right? So what does an ESG score of 30 or 50 or 70 really mean to an investor or in the context of an investment strategy? And I think a lot of the noise around the data frameworks has come really from the inability to decipher what those numbers actually mean and how they're actually derived. So what is becoming increasingly important is the ability to really peel back, kind of for lack of a better term, the ESG score onion, right? So peel back the layers of that onion and really have increased transparency around not only how the data is being collected, but what that data actually looks like at a much more granular level. And that is really key to understanding what an ESG score really represents. So without doing too much of a shameless plug here, I think it's important to address how we differentiate the S&P Global ESG scores. And we do that through a very comprehensive, transparent ESG research process that's built upon direct company engagement. So we do not rely solely on public disclosures from companies, but engage with them directly through the renowned corporate sustainability assessment. Jeffrey, some of your listeners may be familiar with that assessment. But what that assessment does is it ultimately looks on an industry-specific level. So it's an industry-specific survey to companies that focuses on what is most financially material and relevant to any given business model. And we've been doing this for over 20 years. And how that direct company engagement really, makes us different is that we have this unparalleled level of access to information regarding corporate sustainability performance. And that goes beyond what is traditionally or historically captured by just public disclosure documentation. What is also particularly unique to the CSA is it was designed through the lens of an asset management process. And because it benefits from those 2 decades of real life investment performance, and again, it really helps us to identify what is most financially material and relevant. So because of that level of granularity, because we're digging deeper into the true sustainability performance or practices of companies, what it allows us to do and what it allows our scores to be is much more transparent than other providers. And because we're actually providing multiple layers. So, we look at the headline ESG score, but you can also gather information from our scores down to the dimensional component, which is that E, S, and G, then all the way down to the individual industry specific criteria. And again, what that allows advisors or subsequently investors to do is gain a clearer understanding of what actually defines the scores that are actually being utilized as building blocks in these vehicles like an ESG index or fund.
Yeah, and data is getting data and transparency in getting data and being able to sift through all that information, really important. And our network is called the Broadcast Retirement Network. So we're not always focused on retirement plans. But if you think about pensions and 401k type plans, defined contribution plans, there's that role of the fiduciary and that role of being responsible for the beneficiaries who are going to benefit from the plan. You are beholden to them. You are responsible for them. So having this information, really important. Let me ask you, we've got a couple minutes left in the segment. Let me ask you about how far behind is the U.S. relative to other markets? And S&P, obviously a global firm, but when you look at the U.K. and the EU, how far behind are we in terms of sustainability and ESG incorporation?
Well, I think that we have been very far behind in terms of investor adoption, whether it's at a institutional level, trickling down to, if you want to call it, a retail level, right? But what I will say is if you're looking at current ESG flows, whether it's into indexed ETF or passive strategies or active strategies, what we are seeing is a substantial uptick in flows coming from the US or North America more broadly, right? So there is now more of a focused narrative around ESG integration, around ESG data incorporation. But with that, brings kind of the trickle down effect that we're seeing out of Europe around a regulatory perspective as well. So you have the SFDR, which was the Sustainable Finance Disclosure Regulation that was enacted this past spring, or it started really going into full effect this past spring. And while we haven't seen really a similar, regulatory crackdown per se in the U.S. around ESG disclosure, around regulation, we are starting to hear some noise, specifically coming out of the SEC, around the fact that we could see some of these regulations coming into play. Also, this past spring, the SEC created that climate and ESG task force. So I do believe, if I'm looking into my ESG crystal ball, that we will see some trickle down effect in terms of regulation and see some more coming out of the SEC around disclosure.
And word is that also the OMB, the Office of Management and Budget, just, I guess, passed through from the White House to the Department of Labor, Employee Benefits Security Administration, some new rules around that for incorporation into retirement plans. Last question here for this segment of the show, Maggie, and that is, are you seeing more inquiries? Your indices are used around probably in virtually every retirement plan in some way, shape, or form, whether it's a pension or a defined contribution plan. Are you seeing more inquiries from asset owners, for lack of a better term, of saying, "Hey, I want to look at ESG and what are your offerings?" So, in terms of the regulatory framework and the availability, are you seeing more inquiries around that?
Very much so. I would say my time in particular, and I'd say more broadly again in North America, we're also seeing a lot of Canadian pensions, a lot of Canadian institutions coming forward as well. But we are having increased conversations with asset owners in particular. And it's really because, for us as an index provider, it is our role in the greater scheme of providing ESG index strategies to provide a wide spectrum of solutions, whether it's ESG data integration that is designed to closely track a benchmark like the S&P 500, all the way down the line to now solutions or index strategies that address the Paris alignment or climate transition. And what we're seeing is that there's a lot more engagement from these asset owners kind of across the spectrum of these strategies to incorporate them, and not only incorporate the index strategies, but incorporate the data into their frameworks as well. And that is not something that I would see slowing down anytime soon by any means.
Yeah, that's again, great news. It's starting to pick up, and we're starting to catch up here in North America, not just the States. Well, Maggie, I need to take a quick break. When we come back, we'll talk about incorporating ESG and sustainable criteria into an index. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking to Maggie Dorn of S&P Dow Jones Indices. Maggie, thanks so much for staying with us this morning.
Thank you for having me back.
Yeah, well, I always thank the guest for sticking with us because it is kind of it's not a long show, but we cover a lot of ground, and I thank them. And I also thank the audience, of course. Let's pick up the conversation because we talked about data, the importance of data, and the fact that more and more asset owners are really interested in ESG and sustainable solutions. But let's talk about S&P, very well known for the S&P 500 index. I have to think that is probably one of the most popular indexes in the world, if not just here in North America. But let's talk about adding ESG criteria and sustainable criteria to that index. How do you go through that process? How do you do that?
Well, let's first start with kind of your original statement here, because I think it's really key to this conversation, and then we can definitely move into the index methodology itself. But we launched the S&P, or the ESG version, of the S&P 500 in January 2019. So coming on several years of performance on the index itself at this point. But what I always like to point out, especially with audiences that are interested in ESG investing in particular, is what a watershed moment that was for not only the ESG indexing space, but for ESG investing in particular, because as you just mentioned, close to 11 trillion in assets either are directly tracking or are benchmarked to the S&P 500. So when you think about the breadth and the reach of the S&P 500 in particular, applying sustainability criteria to that was a very, very significant move, not only for us here at S&P, but for the industry in general. And I also think that the launch of the index has also helped, and we can get into this a little bit more, really dispel the myth of an ESG versus performance trade-off. And that really is what plagued, to much degree, the widespread adoption of sustainable investing. And that is really based off of the fact, and that this is getting into the conversation around the construction of the index, but the S&P 500 ESG construction, our approach is designed to really closely replicate the risk return profile of that behemoth of the parent index, the S&P 500. And we're doing that by also providing for both meaningful as well as measurable sustainability improvements over that parent index. And I'd like to, yeah, go ahead, please.
I was going to say, I mean, 11 trillion is nothing to sneeze at. That's a large, that's like a country's economy in terms of allocated there. So let's talk about incorporating the criteria. How do you, and I was going to ask you, by the way, about performance, because everyone, since I've been working in this business, which is 30 years, everyone always said, you got to give up some level of performance to get that sustainable, had that sustainable interest or that sustainable lens. And that's clearly not the case when it comes to indexing. But how do you take that criteria? Walk us through, and again, we don't have globs of time to get into all the weeds, but just walk us through how you allocate this criteria, not you in particular, but the team allocates it across this 500 index to get to the S&P 500 ESG index.
Of course. So I think first and foremost, if a lot of the misnomers around the ESG versus performance trade-off came from the fact that historically these indices, or the kind of socially responsible investments or indices, were very much based off of exclusionary frameworks, right? So you had to exclude a bunch of stocks to ultimately, attain your sustainability driven goals. And oftentimes that led to excluding entire sectors or industry groups from the index, which led to, oftentimes increased volatility, increased diversion away from the actual benchmark itself, which led to underperformance. Now, with the S&P 500 ESG index, while the index is by no means designed to be exclusionary, but we do first and foremost exclude a few what I would consider controversial business activities that are generally accepted as kind of the starting point for any ESG index. So we exclude things like thermal coal, companies involved in thermal coal, controversial weapons, as well as tobacco. We also exclude companies that have a low UNGC score, which stands for the United Nations Global Compact. So for those unfamiliar with that, the United Nations Global Compact is really a catch-all for any violators of what I can call kind of these social norms, which is human rights, labor rights, environmental issues, as well as corruption. So companies that are found to be offenders and have a low score in those areas are excluded. Then we also exclude the bottom 25% of companies based on their ESG score within their global GICS industry group. So with those exclusions, what we're really trying to do is exclude the worst offenders from inclusion in the index. So we first make those exclusions, but then what we do is we divide up and we look at the companies on an industry group by industry group basis. And we go down the line per each industry group, selecting those top performing ESG companies until we accomplish 75% of the market capitalization within each of those industry groups. And that's a really important point, Jeff, because when you think about it, it provides a sector neutral approach to ESG investing, right? So we're taking a sector neutral approach. And one of the biggest criticisms around ESG indices right now is the fact that, you're just overweighting technology and underweighting energy. And that just isn't the case, specifically when you're looking at the S&P 500 ESG index. So we're taking this sector neutral approach. We're also market cap weighting the companies in the index as well, which keeps that tracking error really close, providing that similar risk return profile to the parent index itself, which is the 500.
And last question here, and if we'll have to continue this conversation at a later date, but let's just talk about indexing in general. It gives you exposure to a broad market. So in the case of the S&P 500, the top 500 companies, blah, 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 based on 80% market cap, I think, whatever the number is. I'm not the expert here. But it also allows you, because you had this index exposure, it allows you to bring down fees. And as we know, at least in the retirement space, and I would wager in any asset allocation or portfolio management, fees matter here. And so giving an asset owner and an individual, whether you're a retail participant in an IRA or you're a participant in a retirement plan, gives you the ability to have this exposure, broad exposure, and also the opportunity to lower fees.
And I could not agree with you more. So we now have several ETFs tracking the S&P 500 ESG index, both in the US, but as well as Europe now. And I think we're approaching close to 5 billion in assets under management, reflective of that S&P 500 ESG index. I also think what's kind of an important conversation to whether you're an asset owner or a individual is the growing ecosystem around the index as well. So not only ETFs and mutual funds, but futures and options. And I think that's really going to be an interesting area of growth moving forward, is kind of accessible entry points to these more sustainably minded indices or benchmarks like the S&P 500 ESG index. And again, it was a watershed moment when we launched these, or this index in particular. We have several other kind of what you would consider benchmark type ESG indices that track globally recognized, widely known indices as well. And we only, look forward to the future in terms of launching more of those types of indices moving forward.
Yeah, it's certainly exciting, and we'll have to catch back up with you at a later date to see how things are what the trajectory is. But we're going to leave it here. Maggie Dorn, great to see you. Thanks so much for joining us on the program. And as I said, we look forward to having you back on the program very soon.
Appreciate it. Thank you.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.